One of the topics we need to talk about with regard to risk is the role of insurance. Uh, this is probably when you say risk management to most people, this is probably the first thing that comes to mind is the use of insurance. There's some concepts related to insurance that we want to go through, and then there's some things with regard specifically to crop insurance that I want to touch on. What insurance does is it reduces our exposure to risk, and insurance provides a specialized source of liquidity to the business. In other words, it gives the business the ability that if there is a loss, then they can look at the insurance or depend upon the insurance to help provide funds to offset that loss and give the business liquidity. Now, if insurance were not available, it would be necessary to either hold cash in an account or to have unused credit reserves available in order to cover any losses. Uh, some companies will self-insure, meaning that they're actually holding cash in an account that may be invested, but they're holding cash that offsets any losses. There are some companies in the past that have tried to self-insure with regard to health insurance for their employees. There's companies that are willing to set aside or pledge certain liquid assets such as bonds and accounts to offset any losses. But if we didn't have insurance, then in order to really mitigate the possibility of a loss, the company would need to either hold cash or credit reserves. Now, some of the concepts relative to insurance. One is the pooling of risk. What insurance really does is it combines enough small, unpredictable risk so that annual losses for the combined group become statistically predictable. In other words, it's really impossible to predict on an individual basis where an individual will have a loss. Whether that be a loss in terms of crop insurance or a loss, a casualty loss with regard to maybe a collision or something with their vehicle. But whenever the company can combine enough of these small, unpredictable risks into a large group, then we can start to statistically analyze that and come up with more predictable outcomes. So pooling of risk is very important with regard to insurance. Now, the concept of pooling risk uh, really falls back onto the law of large numbers. And what the law of large numbers says is the actual results will tend to equal expected results as you increase the number of cases. So in other words, the more policies that you have out there for a given type of insurance, the more likely you're able to predict what the actual outcome will be. So the law of large numbers is very important when we're talking about pooling risk. Now, one of the things that we need to ask is what is an insurable risk? There are some risks that really are not insurable, but an insurable risk is one where an event is insurable if the probability of its occurrence can be predicted and the cost of the event to the insured party can be determined. So in other words, if we can predict what the probability of an outcome will be, and we know what the cost is going to be if that loss occurred, then it becomes insurable. In other words, the premiums can be determined and we can insure that risk because we know what those probabilities may be of a loss, and we know how much that loss is going to be. Some of the non-insurable events, and you'll see this in policies when you read them, is like nuclear war, uh, things along those lines, where we don't know what the probabilities are of that happening, and we don't know what the loss would be if it happened. So an insurable risk has to meet these two criteria: the probability of being able to predict and the knowing what the amount of loss would be if it occurred. Now, some of the concepts relative to insurance is moral hazard. That's when an insured individual or changes their behavior or their actions because of being insured. In other words, the fact that I have insurance, I may take more risk. Taking certain actions to collect the insurance is another aspect of moral hazard. So there's aspects of moral hazard that go along with the insurance, just simply because if I have the insurance, I may not worry about the loss, and so therefore I will take more of a risk. Another concept is that of adverse selection. And what adverse selection really says is only those that have a risk or a chance of collecting the insurance will take out the insurance. So in other words, in Lubbock, Texas, we're not going to take out insurance for hurricanes because the chances of having a hurricane is very, very, very remote. In other words, only those individuals that would have a chance of a loss for a given cause will take out that insurance. And so there are some people that have more risk, and they're going to be the ones who take out the insurance for that particular risk. So in other words, you may have somebody who has in their family more of a chance of getting cancer. They may take cancer insurance. So adverse selection is also another aspect that comes into the insurance. Now I want to talk a little bit about crop hail or crop insurance because when we're talking about agriculture, well, crop insurance is one of those things with regard to being able to mitigate part of that business risk with regard to an agricultural operation. And there's several kinds of crop insurance, and we won't talk about these in some detail, but mainly just to identify what they are. One is crop hail insurance, which protects against crop loss due to hail. That's it, period. That's all it protects against. You buy the crop insurance, it's usually sold with regard to a certain amount of dollar coverage. And then if you get a hailstorm and if you have a percent loss or a total loss, then it pays. But it only pays with regard to the loss due to hail. Doesn't pay with regard to drought, doesn't pay with regard to insects or any other type of a reason for a loss, only if it is a loss due to hail. What's called multi-peril insurance, or as we're going to talk about it as APH or yield protection is another way that we'll refer to it, is looking at it protects against a crop loss due to virtually all natural hazards, but what it's protecting against or what it's insuring is the yield or the output. And so multi-peril or APH insurance only protects against a loss of output. Crop revenue coverage, which we just listed here as CRC, we're also going to call it revenue protection or RP. It combines the APH or the yield coverage with some price protection to ensure a level of revenue. So we'll talk a little bit in more detail about that. Now the APH insurance or yield protection, what it does is that the producer insures a percentage of what their actual production history has been. So in other words, we look at 10 years or want to look at 10 years worth of production history. What has been the average production off of that particular field or that particular unit, and then you can buy a certain amount of insurance relative to that on a percentage basis. It goes from 50% up to 75%, and in some places, some types of crops, 85% coverage. So in other words, you're saying, let's say for instance, that you have a cotton yield, my APH is 1,000 pounds. If I buy 65% coverage, then it's going to guarantee me a yield at 650 pounds, 65% of my APH. And then there will be a set price that is attached to that in that insurance policy. Crop revenue coverage covers the total revenue. In other words, it provides some revenue protection, so you have some protection with regard to yield and protection with regard to price. You buy a percentage of the yield coverage, just like you would with APH, but then it's going to look at the policy is going to look at what was the price at the beginning of the year, what is the price at the end of the year. It's going to choose which one of those is the highest price to calculate what your indemnity might be. So if you had a situation, in some cases, one of the advantages of crop revenue coverage or revenue protection is that if you have a loss, and the price, and in that particular year, prices were high at the end of the year, but you had a total loss, then you're able to actually be covered by the fact that prices went up. And so even though you didn't have a crop or you weren't able to produce anything because of a loss early in the season, you're protected against a rise, or can take advantage of a rise in prices. So crop revenue coverage has really become a very popular option, particularly for cotton producers. Now there is one aspect, a type of insurance called a group risk plan or GRP or GRIP. What it does is you're saying, well, I'm going to I'm going to insure my crop based on what happens within the county that I'm located in. And so GRP insurance really works best is probably in the Midwest, where their main loss, the reason for loss is in terms of drought. And so it's going to affect everybody within the county. Uh, Group risk doesn't work very well in this part of the country because our main loss is going to probably come from a hailstorm or a sandstorm or blow it out. Therefore, it can be very localized. And so GRP is not really that popular in this part of the country, but it is popular in some of the other areas. Just want to take a moment here to look at some of the numbers with regard to crop insurance in Texas, and we're going to look here at Texas cotton for 2018. You'll notice over here on the left-hand side of this table, you have the insurance plan, and it's YP or RP. RP or some variation thereof stands for revenue protection, YP for yield protection. Revenue protection would be the crop revenue coverage, and the yield protection would be your APH coverage. If we look at that, you can see that most of the policies in Texas were revenue protection. They're on the top line. 32,231 of those were revenue protection policies out of 44,000. If you look across that, you see the liabilities over on the a little past the middle portion of the table. In other words, there was $2.5 billion worth of liabilities associated with those particular policies. The premiums that were taken in for those policies were $628 million. There was some subsidy it's paid. This subsidy is coming from the federal government with regard to their crop insurance program. And the indemnity numbers represent the amount that was paid out in terms of for losses. So out of about $2.5 billion worth of liability that was there because of the policies, $962 million was paid out. Overall in Texas, in terms of cotton, there was a $1.128 billion paid out in terms of crop insurance indemnities. Now the loss ratio is taking the total premium, or the total premium, and dividing it by the indemnity. And so if you say there on revenue protection, they had a total premium of 628 million, losses of 962 million. So there's $1.53 worth of payout for losses versus what the premium was. And so if you look down there in Texas total the loss ratio is 1.5. So what that's saying is that we're in an area, or Texas is, in cotton production, where there is a significant amount of risk in terms of cotton production, and that the coverage, the amount that was paid out for crop insurance coverage on cotton in 2018 in Texas was paid out was $1.50 for every dollar worth of premium that was collected. Now, this looks at 2019 in Lubbock County by itself. And again, you can look down those. There are the different types of plan, the revenue protection or the yield protection. And then in this particular table, it also shows the level of coverage. And what you would see mainly is that, first of all, most of the policies in Lubbock County were revenue protection. And the policies that really were, the majority of the policies were either 60, 65, or 70% coverage. What the percent coverage level is the amount of the APH that the producer is paying for it to cover it. And most of the time, this is what we call buy-up insurance. In other words, basic catastrophic insurance is 50%. You have buy-up insurance, which means that you pay additional premiums in order to get to a higher level of coverage. If you look across there, it's the same kinds of information we had in the other table, and then we have the loss ratios. I would point out that if you look down at the bottom there, the totals across there was 277,000 acres that was covered in cotton coverage in 2019, 1,579 policies. The loss ratio was 1.14, so in other words, it was $1.14 paid out in indemnities for every dollar worth of premium that was paid in. So there's $27 million paid out, and premiums paid in was $24 million. If you look there, below the total numbers, there's the revenue protection and yield protection, and the number there that you see of the different policies. And you can see that most producers are choosing to buy revenue protection, and then most of those are choosing to be between 65 and 75% worth of coverage. This is a look at the past 15 years of history in Texas with regard to crop insurance, and this is for all crops, whether it be cotton, corn, or whatever. And if you go back to 2014 through 2018, you'll see that there's some differences, particularly let's look at the column for loss ratio. Some years the loss ratio is below 1. Some years the loss ratio is above 1. You'll notice in 2011, which we had the really dry, it was one of the record drought in Texas, the loss ratio overall was $2.36. For every dollar worth of premiums paid in, there was $2.36 paid out. So this kind of gives you an idea of how crop insurance has performed in Texas. This is a look at the indemnity map for 2019. One of the things that you will see there is that the darker the colors there represent the higher the indemnities. In other words, anything that is the darkest color was over $10 million paid out for that county. So as you can see in 2019, the main concentration of some large losses were in the Dakotas, and then of course in the Texas Panhandle and South Plains. Now this is looking back at the 2011 indemnity map. Whenever we had our drought here in Texas, you'll see that there was much greater losses in Texas and because of the drought, and so it's just a look at where the crop insurance losses were in a particular year. I don't want to spend a lot of time on this, but this was a study that we conducted a number of years ago doing some simulation work, looking at a particular farm and different types of insurance products, whether it's no insurance, catastrophic insurance, multi-peril insurance, crop revenue coverage, GRP, or whatever. And this is what's called a cumulative distribution function. And so if one of the things, if you look at, let's say the probability there of 0.5, if you say what is the probability, the 50% probability of getting a certain level of net cash flows. If you look across there, depending on what insurance product that you had. Now, the one that it's really difficult to see over there, and sometimes it's really hard to see, but the CRC, or crop revenue coverage, at 85% had the highest expected net cash flow over a 10-year period versus at 50%. And it was the highest net cash flow over all probabilities. The next one back there is the CRC 75, which is the one that you can probably see fairly well. So what this is saying is that, well, these particular insurance products over a 10-year period, looking at net cash flows for the northern panhandle farm that we were looking at, gave you the highest probability of a certain level of net cash flows. If you also look at this in terms of the southern subregion, the other one was the northern subregion, the southern subregion, which is more predominantly cotton, you had some of the same distributions with regard to policy types, but it was much more clustered towards some center. And one thing is, you look at the red line in there, that is catastrophic insurance. Catastrophic insurance is a 50% coverage level of APH type of insurance. And so you can see that there are some insurance policies or types of policies that are actually less profitable over time than just a straight catastrophic type insurance. Now, I want to briefly talk about some of the other types of insurance that you have. One is, of course, what we call casualty insurance. Property insurance insures for loss due to fire, wind, flood, accidents, theft, and malicious destruction. These types of insurance policies on homes, barns, commercial equipment, tractors and combines, automobiles, these types of insurance coverage. Particularly, I think, in terms of in an agricultural operation, there are certain types of some of our equipment, particularly cotton strippers, combines, and tractors, that we may want to have some type of insurance on them. We may be required to have that if it's being financed. But you have what we would call casualty insurance. Then another type of insurance that can be very important is liability insurance, which insures you against claims arising when a person who suffers a physical injury or an economic loss on your property, or for some action that you took. So it's very important that you have liability insurance on a business so that it protects you, that if somebody walks into your store, falls down, breaks a leg, that you have some type of coverage on that. Social insurance, whenever you're in business, you need to have workman's compensation or some type of insurance that insures your employees against injury. It's required, it's very important that you have some type of workman's compensation or employee insurance to protect against a possibility that you may have a person that's in your employ that gets hurt. You can have some insurance there that will cover them. Another type of social insurance that we all have to pay is Social Security. You have to be, as an employer, you have to pay employee FICA taxes. It's withheld from the wages. It has to be matched and paid into the to the government. So Social Security, again, is a type of insurance policy. Of course, another type of insurance that nearly everyone is familiar with is health or medical insurance, whether it be for your own family or whether you are buying insurance for your employees. Again, medical and health insurance is a very important aspect of a business these days as to whether you provide that insurance and how you provide that insurance for your employees. Uh, we could have whole courses taught with regard to medical insurance, but just keeping in mind that medical insurance is one of those types of insurance that, again, can certainly provide liquidity in case of a loss. Life insurance is another type of insurance that many people need to consider. There are different types of life insurance. Again, we could get very detailed here, but life insurance may be one of those other things that over time you might look at the possibility of what type of insurance do I need to have to protect my family or to protect my estate after you're gone. So life insurance is certainly another type of insurance that you need to consider.